In today's dynamic financial landscape, building your own analytics platform can be a costly and time-consuming endeavor, taking years to develop. But what if you could fast-track your analytical capabilities? Introducing JSE Trade Explorer, our groundbreaking analytics platform, ready to go to analytics delivered directly to our members' desktop within 24 hours. Help boost your business with JSE Trade Explorer. With its powerful analytics, intuitive interface, and flexible API, Trade Explorer is the essential tool for any trading firm that wants to succeed in today's competitive market. The value of Trade Explorer is clear. It gives you the power to understand your own trading metrics, identify where you differ from your peers, and gain a bird's eye view of your firm's performance. With Trade Explorer, you can drill down all the way to one trader, one stock, or one day to get the insights that you need to make informed decisions and improve your bottom line.
All right. Good afternoon, everybody. I was convinced I wasn't going to do a shameless product plug today. And then they played the video, so thank you for bearing with us on that one. So first of all, a warm welcome to my panelists. There is one more coming on the way. We're just sorting out a small mic issue. Their details are in your program, but we have got Andries from Investec, one of our broker representatives today on the equity broking side, going to give us some of his insights. Yanela from 91, representing the buy side, who's going to bring us a client perspective in this discussion. And my last panelist who is on his way up, Richard, who comes today with a wealth of knowledge about European market infrastructure and hopefully some learnings on how that applies to South Africa. So we're talking today about fragmentation of dual-listed stocks on the JSE, and before I bring in my panel of experts, I'm going to bring up a few slides for you. I started my career at the JSE working in the index business. So I feel a little bit naked unless at least I have at least one slide. So I'm going to share a few of them with you as we bring those up. I must just say for full disclosure that no AI was used in the generation of these slides. They were handcrafted with love by a human being. So I'm all for the job security. No ChatGPT. So either, and in fact, one of them is even done in Excel, which is a dirty word in data science circles. So please bear with me. All right, so before we get into the discussion, I think our first slide really has got nothing to do with market fragmentation as we're speaking about it today, but really speaks about a different kind of fragmentation, which is register fragmentation. And this is important, I think, just as some context, because our predominant performance benchmark in the equity market, the Swiss All Share, is based on register. And what we're showing you here over the last 10 years in the blue line, and don't worry too much about the numbers, but just to give you some sense of the perspective, this is straight data. So the green bar at the bottom shows you the total market capitalization of all JSE shares that is accounted for on the South African share register. The orange line on top of that adds the incremental market cap of all of our dual-listed companies that are held on offshore registers. So when you think about JSE market capitalization, the available investable universe, obviously some that is in South Africa, some is offshore at any point in time. That varies based on listings, corporate action, supply and demand, and so on. And you will notice how that trend has changed over time. The blue line, the line series shows you that percentage. Very interesting that has come down over time, around to about 39% today of the total JSE market cap is reflected on the straight register. Now that could be a function of an increase in total available universe, which I think is a good story in terms of opportunity, and of course a function of where those shares are lying at any point in time. I think maybe this is a little bit closer to what we're going to speak about today. And when we're really talking about fragmentation today, we are talking about liquidity. Where is the price formation? Where are trades reported? So we're zooming in. This graph is dual listed counters on the JSE, and where we are seeing their value traded over the past, this is over the past 2 years, quarterly chart. The red bar at the bottom is the percentage that is traded on the JSE, which is what we can access directly in South African Rand. The blue bars are the Americas, mostly in the form of depository receipts. Orange in Europe, and the top in turquoise is APAC, which is effectively BHP Bulletin. And you'll see there, this tells a very, very interesting story. I think the piece that I really want to call out, and we're not really going to interrogate the graphs too much, but the piece I want to call out is that even though we've seen some of the total flows come down, the portion that is traded in South Africa as a percentage of total trade has been relatively stable at between sort of 22, 23, 25% over the past 2 years. So this data is not telling us that there's a narrative that the JSE has got a decreasing share in liquidity for our dual listed counters. Of course, as the total volume does come down, and we'll speak a little bit about that today, we do get a smaller rand value of that. But in terms of proportion of addressable and, in fact, non-addressable liquidity, we're hovering at around about 20% up to about a quarter. Okay, this is all aggregate data, very interesting in terms of trends. I'm going to call out one or two individual companies just to give you a sense of what we're seeing around where the liquidity is going, where the price formation is happening. This chart shows you process. It's obviously not interactive on this particular slide, so you don't get the full value of it. But the center ring is really showing you region, red for Africa, orange for Europe. The middle ring is country, and the outer ring is trading venue. So you'll see that the JSE is reflecting right about 11% on this particular look-back period of process trade on a global basis. I think what you will find, hopefully as interesting as I did, is that the Euronext Amsterdam number is showing about 28%. That's where its primary listing is, showing a significant amount of European fragmentation outside of Amsterdam across various European trading platforms. Again, some of it not addressable, and Richard will spend some time talking about the liquidity fragmentation story in Europe in particular. Okay, I'm nearly done. 2 more slides. All right, this is our quiz slide for the day. All right, so this South African mining company has got 100% of its shares listed on Straight, or registered on Straight, but it does have a very active DR program in America. So you'll see that the blue bar is reflecting the proportion of its trade in the Americas, mostly through its DR program. As an aside, that's quite an interesting point when we think about analyzing this data, because you can't just consider liquidity on ISIN alone, where there are DR programs that are not trading the ordinary share directly. One has to consider that in terms of liquidity profiles. Only just over 20% trade in South Africa and a small sliver traded in Europe. Again, this is not a dual listed company in terms of its ordinary share. It is a top 10 stock on the JSE in terms of ADV for this time period. I'll leave you all to secretly write down the name of the company. Valdine knows. Thank you, Val. The answer, of course, is Goldfields. So Goldfields, when we think about liquidity and fragmentation, we're not just thinking about primary listing and secondary listing. There is a lot of competition for different venues out there that we need to consider. Last but not least, I will just put up Anglo American, one of our other top 5 stocks. Again, you will start to see here the proportion traded on the LSE, perhaps a little bit smaller than you may have thought initially. Of course, you'll see that number on the JSE, what we are experiencing. This data is all pretty sensitive to what look-back period you pick, so I don't really want to cherry pick too much here, but happy to, if there are any questions afterwards, to work through any of the data. Okay, that's enough of me. I think time to pull in the experts who you are all here to talk, to listen to. I'm going to start, I think, Andries, I'm going to start with you because you're furthest away. How's that? So looking at some of this data, I think maybe the question is does this align intuitively with what you're seeing on the desk? I mean, is this your lived experience when you think about your listed companies locating liquidity and so on?
Yeah, absolutely. I think just for a start, again, I wanted to say thank you very much for the JSE and all the sponsors here today to create this platform for us. I think it's a wonderful opportunity for us to really talk about these issues. And liquidity is very much core to our strategic focus. If we look at our execution, product development, and how we think about things. And when you put up these graphs, as you say, the time frame is obviously important, but it's something that we look at a lot. And part of the thinking that we have on the desk about how we can kind of solve this execution problem for our clients Our clients are actually expecting a hell of a lot more of us in terms of understanding the complexity, where these products are actually trading and how we can best access all the liquidity that's actually available. Now, we've actually spent a lot of money and time on developing infrastructure that allows us to access this data, and we're working with a number of different providers, and we've been chatting also to Richard and them just about understanding what that product can give us. But the reality is you have to really invest in the data science to understand how these dynamics are playing out in the market, and this is really core to how we think about execution and providing that product to our client, because it's always about having to try and quantify. We have to continually evaluate, assess, and enhance. That's core to our philosophy of how we think about our product, and this aspect and dynamic is something that really feeds into that. And then, liquidity solutions, as we like to call it within that suite, forms a very important part of the tool set, because you need to ultimately try and access it in the most optimal way. If you are trading in an ADR to try and give somebody a rand fill in South Africa, there are quite a few different pieces that need to kind of fit in, and it has to happen very quickly. We're talking about things happening at a micro and millisecond level to ensure that the fill that we're giving to the client and ZAR is actually a good fill. So I think for me that's sort of the first piece. It rings true to what we think and see, and it's something we live on a daily basis. Ultimately, you need to be able to get the best possible liquidity for your client at all times.
Andries, I was just reflecting that a lot of your answer focused on data and technology, and very little on people. How have you had to work with your people to get used to engaging in this world?
No, and that's a very valid point. I think it's something that you cannot forget. So, I joined Investec 2006. So, my life for the last 18 years in South Africa has been about, really focusing on this sort of problem set that the market offers us, right, in terms of being able to get the best execution. And if we look at the people that we have put in place, we've really gone with the approach of finding people who have a very strong academic, scientific kind of background. We're talking about people with physics type background, data science, computer science, and understanding business and understanding markets. So there's a real mixture of skills. So that is the reality of what we're facing now in broking. Technology and data science has become a core competency in broking. We cannot ignore that. We need to and that's become very important in terms of the people that we use in the execution space. Of course, we need to still keep the human touch. The human touch does not go away. It's core to Investec and core to our culture in terms of how we like to service our clients. But at the same time, we need to make sure that we stay in touch with the technological developments that are out there, and be able to actually service our clients in the best possible way. So what does it mean for a slightly more traditional sales trader? Well, they have all these tools to their, on their desktop to ensure that they can do what they need to do, and they get to talk to the client about other things. There's also a lot more about execution consultancy and maybe a little bit of two-way dialogue. How do we best execute, this specific stock? Also thinking about what sort of real-time analytics are available to empower, the sales trader to give the best possible feedback to the client real time. So people are core to it. It's about getting the people with the right skills, in place. But at the same time, that human element relationship with the client, that doesn't go away. It's not like a client's now only talking to a machine. It's key that human touch relationship part remains.
Perfect. Well, all right, Richard, I'm going to turn to you, and I know you've got 2 slides you want to share with us. And one of our normal conditions in South Africa is to believe that we are unique, and often we are, and sometimes we're not. So Richard, maybe can you take us through perhaps how Europe is thinking about fragmentation of liquidity, what we're seeing there, and perhaps any insights you want to share.
Absolutely. So I'll talk through this slide in a moment. I've got, so Andries is much more techno than I am. I've got the old style index cards, but you're using the iPad there. That's very, very high tech. So, but just while you're having a look at the slides there, and I'll talk through some of the numbers and give you a description. But I thought just to pick up on that point, in order to produce this slide, we collect 2 billion data points per day from the European markets. That's just the European markets. The US plus Asia, we more than quadruple that number. And that of course is spread amongst roughly, this is equities, so it's roughly 16,000 names that are being traded every day. If we want to bring the ETF world into that, there's 4,500 ETFs now listed just on the LSE. There's another 3,500 listed on the other European exchanges. And I use the word other European exchanges to include the UK. So what we really see there is a huge big data problem, hence the big X weighting, by the way. And to your point, this stuff has to be gathered, it has to be cleaned, it has to be curated. And that's even before we get to start to analyze it and look at it. And even to produce an accurate chart, for example, like the dual listing charts that you were showing us earlier, or this, which is a multi-year trend. So there's an enormous amount of data that has to be collected. There's so much data that in the background, you said that, so I don't think it's a secret that we provided the data for that chart. There is machine learning, you said there wasn't, but there is machine learning behind that. And that has to go into the whole process of cleaning the data. These days, it's called self-healing data. So if there are problems, then the ML goes in and it finds out where the issues are and cleans it. And I bring this out because this is the challenge that we face. And yes, South Africa is absolutely unique, but I think this is one of those things that is a major challenge for broking in particular worldwide, where we're trying to provide a client service. So now at last I'll get around to explain the chart. So the bottom layer, the light blue, is the lit order books in Europe. We go back to 2016, but the big jump you can see in 2018, let's start looking there, when the intraday order book was just under 50% of overall liquidity. So that was the point at which they introduced MiFID, and now we're down to 37% this quarter, and for the average last year. That's a huge jump. That's 12% of liquidity that's been taken away from the order book. And of course, that is the core mechanism for price formation. It's not as dramatic in South Africa, actually. And so we ask a few questions here. One is, I thought MiFID was about trying to draw liquidity back onto the order book because that's the most efficient method of price formation, but we can see that hasn't really happened. In terms of dark trading, and that's the pink line just above, that's pretty stable actually, and that's partly because MiFID put caps on dark trading. I'm personally of the view that if some of those caps were removed, we would see more interaction in electronic trading in those dark pools, which would then encourage consequent trading in the lit book and encourage more value traded into the lit book. The real cause is the yellow line, the yellow layer, if you like, of the cake, and that's the auctions. And you can see now, and this harks back to what James was saying in his speech. The auction is now really dominant in terms of the electronic execution of orders. It's up at 20% of the overall market, because we haven't talked about the top two layers yet, which is the off-market stuff. And it's really that's been sucking the liquidity out of the intraday lit order books, with a consequent impact on price formation. So why is that happening? In a nutshell, there are many different reasons, but the main cause is the growth of the ETF market. That can't be regulated out. But if we look at some recent BlackRock reports on the ETF market globally, it's growing by 10% a year, estimated to be 14 trillion assets under management this year. In particular, we're seeing a big drift towards, well, actually not so much a drift, but the addition of active ETFs. That's having a big impact on drawing what would normally be a traditional mutual fund flow into the listed market. And of course, that's all NAV trading. So that's really skewed towards the end of the day, and therefore towards the auctions. We've had 13 of the last 40 biggest auctions in the last 18 months. Each time we get a rebalance, we get another record day. And the last one was 31st of May last year, when 55 billion went through on the closing print, which is 4 billion more than a full day's ADV in Europe. So it's a huge amount of flow. So the theory goes, I think most people would agree with this, is that because of the reduction in lit order flow during the day, more flow is therefore going off market. And I'd like to think of that is it's the high touch traders come back. So for so many years we've been watching the electronic trading trend kind of take over, and that sort of reversed. The big bump that you see in that turquoise line, and this is really interesting actually, because the blue line at the top is principal trading, so risk trading and capital commitment, mostly from the investment banks within Europe. And we can see that that's actually reduced really since the 2020 COVID crisis, and it's stayed reduced. And that's been replaced by negotiated trades, which can't be done electronically under the rules. Some of that is kind of meet me in the auction type trading, executing high touch, but at the auction price, and also in trading day. So when we think about that, we can see that natural liquidity is moving off of the order books and into the, we can call it the bilateral trading, because strictly speaking, it's not OTC, it's not off exchange, it's still on exchange, but only because it's reported as such. If we think about it in those terms, the yellow line down is multilateral trading, what we can call accessible liquidity for anybody with an algo. Above that line, it's you're either trading, but you're always trading bilaterally. You're either trading directly with either a so-called SI, which is an investment bank, or it's an electronic liquidity provider. And that's the market structure that we see in Europe, which is actually, there are strong echoes in South Africa, with the difference being that there isn't the same sort of level of movement into the off-order book market, which is a good thing. So I've spoken for quite a long time now about this. And whoops, sorry, just to go to the next slide. So this is just to show that actually, if we look at European overall volume traded over going back 7 calendar years now, it's not really changing that much. It's very, very stable and very stagnant. And I think this is where the dual listed conversation comes into play, because if anything within South Africa, within the dual listed universe, we're seeing that South Africa is actually not losing, but actually very slightly increasing its market share of dual listed stocks in the 8 major names that are traded here that are also traded elsewhere. I'll just finish on one of my favorite examples, which is Prosus, which you showed us there. So last year, I think at this conference, we looked at a bubble chart and we saw that a Prosus trades in 28 different venues just within the European space. And it's 3 different listings. Maybe there's a bit of a quiz here as well, which is JSE, it's the Netherlands, and the other one, anybody, I think Layla, you know the answer, it's Warsaw. So what we see is not only is it very fragmented across the venue categories, but also if you look at the sort of if you look at the underlying indexes that Prosus is involved in, is listed in, it's 58 of them. So that means there's 58 ETF tracking indexes that Prosus is participating in, and you can see how it's attracting flows just from the growth of the ETF segment. And that's how some of these things are interacting, hence the complexity that Andries, you were discussing. I think I better stop then.
Thank you, Richard. And I think my important takeaway from that is that the same the same forces at work in Europe, in European markets and venues, are effectively impacting our dual-listed stocks, most of which have some form of listing in Europe. So these numbers are really, when we talk about fragmentation, the piece that's outside of South Africa, the 80% that we referenced earlier, this is how it's split. And an important thing to know what we're up against. All right, Yanela, thank you. You've been very patient. We'll bring you in now. And maybe to start, when you hear these conversations about market fragmentation and market structure, what's going through your head from the way that you run your business? I mean, are you venue agnostic? Does it matter to you if you're buying these stocks in rands or euros? But what is your lived reality?
Well, so thank you very much, and thank you to the JSE yet again for organizing. Look, so 91 being quite global with trading desks in Hong Kong, New York, and London, we get the benefits of the fragmentation, optionality when it comes to trading venues. But for our clients here in SA, in particular, where liquidity is where we go. And sometimes we find that the pool of assets that we manage for our clients, you can't easily tap into that liquidity and be satisfied in the local market. So as he is referring now, Rich, on process, you could only get so far in the local market. There are bigger questions as to why that is and where we're going forward and how we could try and readjust that. But I think that's a topic for another day. But for now, I think for us, liquidity is above everything else. So we are indeed venue agnostic, but we do face some challenges. Process, the likes of for some of the ADRs that you go into our afternoon sessions. You get some flexibility in trading those, but we do struggle with some that are time zone sensitive. We struggle a lot with South 32, since we're mentioning names now, so I guess I could also mention the stocks. So we do struggle a bit with South 32 because, we're fast asleep and there's no familiarity in terms of the asset class from our Hong Kong desk. There needs to be a much, bigger issue to be dealt with, and this is what Andries was talking about, the trust between the counterparty and ourselves. So from a buy-side perspective, you cannot basically not be agnostic. So you have to. Unfortunately, there are cons to. Fragmentation is great when it's suitable and there is activity. But being in an EM market, with where we are in the cycle globally, EM has not been favorable, and you find that. Liquidity and liquidity providers prefer to be centered around markets that are more developed. That brings about a challenge for, the players that are more specific to local. Even worse, it brings about a big challenge for those players, now brokers, traders, sell side, that don't have the technology to access those markets. So we find ourselves in a situation where we applaud a path, but the other side, we caution because, it's eating away from some of the liquidity we face in SA. So I loved the chart that you just showed because that's a lovely description of where this activity is happening, even in the European market. So I find it quite interesting. Yeah.
Andries, I'm going to come back to you on that topic about addressable liquidity, and it's come up a few times today. So this sort of bilateral liquidity that's not accessible to you, how do you feel about the seemingly growing segment of the market? Does it keep you awake at night? Does it not bother you at all?
Look, I think this is something we've actually thought about a lot, and it's not actually specific to deal-listed stocks only. There's a lot of activity that's happening. In South African names, that's actually happening between foreign counterparties, and that doesn't necessarily touch the JSE link market at all. So as part of that, you have to really think, what are the ways to kind of bring some of that liquidity back to South Africa in a way that South African buy sides can also interact with that liquidity. So that's a lot of the thinking. I mean, ultimately, we know there's an obligation to actually put that store on the exchange and report it in South Africa, and we always help by that as a local market participant. But that's a reality because some of this liquidity will never find its way into the central order book. Somebody might be looking, and I'm going to use an example here. They're looking to buy 2 million Shoprites on the day. Let's not talk about a deal as the stock here. Let's take one of the retailers. And they think, okay, fine, I can go into the market, I can participate, I can do 15% of the volume, maybe of 1 million of these. But at the same time, I'm happy to take another 1 million right where the market is at that point in time, right? Now, he's not necessarily always going to give, the buy side's not going to give that necessarily to a broker and say, do that for me. Where, there are tools that are available and a lot of the thinking we're doing to say that can we then have an indication of interest that give the buy side that anonymity. They don't have to show their hand. It's just an indication. And if there is a potential opposite counterparty, you bring it to the market and you book it on the JSE. So there's a lot of thinking in that space. And that goes for deal-listed stocks where you say, well, fine, we're happy to go and look at the offshore line where there are often bigger blocks available. And there's going to be obviously some FX risk, some theta around the carry, etc. But you need to think about it in that way. You need to think about, how can I access all this available liquidity? Now, it's not going to be everything because there's still going to be some of the stuff that's purely reported, between bilateral counterparties. But, that's where we're going. I don't think we can kind of unwind this thing and move away. It's unfortunately the nature of the beast. So, yes, what does it mean? It means that you have to continually evolve and innovate, and you need to think about different ways that you can try and add value to your client in that space. It's so I don't think there's an easy answer to that, and it's a problem because clearly as a broker, I want to be able to access all the liquidity that's available. There needs to be a playing field where everybody can do it, but at the same time, some of this liquidity is not necessarily always going to be available to everybody because what is the reality? Unfortunately, in certain instances, if you are putting flow onto a central order book, there are predatory strategies that are trying to take advantage. There are all those things around information leakage that you have to be cognizant of. So in certain instances, you might have flow that you only want to expose to certain counterparties who really want to do a block. So that's a lot of the dynamics, Mark, that we have to think about this as brokers.
Now, Yanela, you and your broker are staring into this world of complexity. There's local listings, offshore listings, DRs, accessible, non-accessible, lit, dark. I'm maybe a little bit curious here when you've cited on all of the data that comes through market data. You may be having conversations with your broker around, what's accessible and what's not, and if not, why not? How does the client think about setting expectations with their broker in this space? Is that a bilateral conversation? Is it something that you carry? Is it something that you let your broker lead in terms of what's possible?
So firstly, when we interact with any of our counterparties, we incentivize, we try and encourage access to liquidity, right, at a reasonable price, at whatever venue there's availability. Now, the challenge with that is that you find that sometimes due to infrastructural challenges, certain counterparties won't be as advanced as others, right? And that's, they might not have FX desks to manage the flow when it comes to dual-listed names, etc. So it brings about a challenge, and it's one that we've been cracking our head. However, it is very important that in the sense that we're also trying to develop the South African trading society, as much as possible. So the data that I look at, it's a typical data, participation rate, whether I'm actually losing out by not trading with a counterparty that has access to those different venues. Do I actually benefit from, these smart order platforms? Or is it a matter of the fact that it's just there is no liquidity during that time? So you need to be also reasonable, and I think that's where partnership with our counterparty comes in. However, I do think, just if we remove data, I do think there's also needs to be a lot more effort from counterparties and also the exchange or the exchanges in seeing how they can partner with each other to make it easier for the end client, and not end client 91, end client, whoever the savings individual is, pensioners, etc. Why? Because, there's a lovely case that I always refer to, and a dual listed name, London, South Africa, Botswana. We do very well in the London, Joburg, and you try and arbitrage those two, you'll struggle, right? However, we've got a flat price in the Botswana line, right? That's, for me, clearly there's something broken there, Clearly there's there should be an incentive from both counterparties and also the exchanges, where there's different exchanges, to see if a solution can be found to that problem. So it's those kind of things for me that I think there needs to be a focus going forward. It's where to say, okay, cool, we as a country, or rather as a market, the SA market, we're struggling because volumes are moving lower, right? What's the impact on your trading now as we, the client, have given you an order? How are you going to tackle this situation? And I think that's where we need to start thinking, because the reality is we've had dropping volumes, and most likely, we'll either plateau and recover from now on, in my view, depending, someone mentioned the elections, but depending on how things will go as we go forward. But I do think we need to start thinking in the context of the volumes that we have, when we are partnering with our counterparties, how best is it to trade this ticket? And if it requires infrastructural investment, what kind of investment is suitable, considering that some players are just not at the same level when it comes to those investments? So those are the challenges that the buy side stresses about this all the time, because you've got this joint obligation of saying you want to make sure that you get the best price with as little impact as possible, but you also want to make sure that we don't find ourselves with two brokers and an exchange with 20% of the current volumes that we have. So these are the bigger things that we need to start thinking about. And of course, these are discussions that we need to have with companies that start listing and consider listing elsewhere. We've had enough data now to say what has been the impact for SA, and whether it's resources, whether it's, some retailers tried to go to Australia and failed, but whether it's, depending on which sector, how has it worked? What's the impact? So those are the thoughts that we need to start considering.
That's very valuable insights, thank you. And I think there's such a fine line here for us all to think about our own individual businesses, but also what is the role that collectively we need to play to support the South African ecosystem, and hopefully we'll have some time to touch on that. Richard, we were talking yesterday, and one of the phrases you brought up was this concept of compression of choice for the buy side, which I found was quite an interesting thought. Why don't you take us through what that is?
Yes, I think it goes actually directly to that point. We've been seeing, for many years that I guess the phrase that's often cited is, we've been doing more for less, more with less. So the complexity of the global markets, whether it's the ETF influence, whether it's fragmentation, whether it's dual listings, fragmentation is just another dimension of, dual listing is just another dimension of fragmentation. But what this all comes down to is it's getting more and more expensive to provide that service to the to the buy side. And I'll give one example of that in a moment. But if we think about it, the technology that you need just to collect the data, just to keep it clean, although we used to spend a lot of money building algos, but now the amount of data and the complexity of that data, and it's not just a sell-side problem, it's a buy-side problem. Actually, the buy-side, I think, are much more sophisticated than say 10 years ago. They've also invested across the planet in these infrastructures, and they spend a lot of money. So actually now the buy side are just as savvy in terms of the data as the sell side. So to compete and to keep up, you have to make the same investments as your client. Very often those clients are global tier one, and therefore they have all the answers. So I think what we're seeing at Big XYT is an industry shift towards sort of outsourcing the hardest stuff. And I think that a call out to JSE and to you, Mark, is that Trade Explorer is an extremely innovative concept. We don't see this anywhere else, where an exchange is coming out saying, look, let's take the hard work. We'll normalize the stuff that's actually there's not a huge amount of added value in tick data. And if it's not clean, it's going to be cleaned, analyzed, and then it's going to be delivered. And so that's what JSE is doing, and I think that's a remarkable new innovation. We don't see that anywhere else. But when it comes to and I think actually to my point that I was trying to make was that in a very roundabout way was that is leveling the playing field across the broker community, and that gives you the value that you don't have to be a global player with economies of scale to be able to create and maintain these infrastructures. You can be a domestic broker without the same level of scale and still be extremely competitive with those who have got that kind of scale. So I think that's key. But the example I wanted to use was that what we're seeing is around, particularly with the buy side transitions, whether it's transitions, inflows, outflows, all those sorts of things. And so the buy side demand seems to be moving towards having a way of discussing in detail how a basket should be traded, what a benchmark is, and we're not talking about the VWAPs and the implementation shortfalls. We're talking about what can this stock, with all of its fragmentation around the globe, in terms of liquidity, what can it absorb? If I'm onboarding a big new mandate, or if I'm offboarding, how much is it going to cost the portfolio, and how much do I need to be able to charge going forward for exiting the portfolio? So we're seeing a big demand for that on the buy side. And what's quite interesting is that that's a discussion that needs to be had between the buy side and the sell side, because it's the sell side that needs to execute. So I think that's an area where we'll see a big kind of conversation taking place between buy side and sell side.
Thank you. Perfect.
Yeah.
All right. We're nearing out our end of time, and I'm going to, in a minute, ask for some closing comments from my panelists, and particularly I'm going to challenge you for a call to arms around, how should South Africa collectively be responding to market fragmentation, whether that's in your own segment or a different segment represented. But before I do that, I'm going to go to questions, and please do submit your questions on the WhatsApp line. That number was put out a bit earlier. I've got our first question here, which is not about fragmentation at all, but about index harmonization. But I'll deal with it very quickly. So the question is, what are your thoughts on how the first phase of index harmonization might affect liquidity in the remaining grandfathered stocks, with the transition to SWIX exposures in the vanilla indices at the March rebalance? If foreigners come in and buy up stock and take it offshore, we should see a knock-on impact at the June rebalance via reduction in SWIX floats. This was the case after BHP lost its grandfathered status. All right, so for those of you that followed the question, you'll know exactly what it means. For those of you that don't fuss about index harmonization, then less relevant. But I really think that there's a difference here between short-term impacts and long-term impacts. Anglo-American, to mention the names, is the last stock in the all-share that does have a grandfathered status. All of the rest have, over the last 2 years, lost that status and had their weighting changed to SWIX already. And I think the point about BHP is 100%. I think one only needs to look at how, the last 5 or 6 grandfather stocks have been impacted as that weight change has come through the index to see what the short-term impact will be. I think more importantly, the long-term impact is that we end up with one benchmark. There's one story for South Africa to tell. There's one place or one contract to centralize liquidity in. And I think those simplification, rationalization benefits ultimately are hopefully going to outweigh any short-term impacts or knocks that we may see, in fact, next month in March as this gets implemented. All right, are there any other questions that have come through on the line? I'll keep an eye on the screen. We can pick those up if need be. All right, I think then that gives us a few minutes for closing comments or remarks. And Tris, I think I'm going to start with you at the end of the line, if that's okay. Any thoughts on what's next in the fragmentation chapter and what should we be doing about it, either individually or collectively?
Yeah, I think maybe I'm going to sort of veer off that question a little bit, and then I'll come back to it. I think for me, and I think for the whole community, liquidity in general is a concern and remains a concern. I think enough comments have been made today around the macro environment in South Africa, which, clearly there's a lot of aspects there that we don't control. But, I think government-private sector engagement and collaboration there is key going forward. But then we can go back to kind of things that hopefully we have a bit more control over. And, I think aspect there that we need to try and leverage is our BRICS membership and looking, for instance, at some of the Chinese ADR listings, that's in the US, and some of that might be at risk, just looking at how the dynamics are playing out between the US and China. So, is there an opportunity for us as South Africa to try and get some of those listings here into South Africa? I think that's the sort of things we really need to think about. Other thing that we hear a lot through our ECM and corporate finance businesses is just the concerns that some of the corporates have in terms of their listings on the market. And they've come to us and talked to us about now, what can we do to get this liquidity to improve? So I think, we actively speaking to a number of corporates in that space and say, well, what can we do from a market making perspective, etc. Even just looking at our corporate broking business that we have in the UK that's very experienced in doing that sort of thing because it's core to that UK market. So those are somewhat of the ideas that we're thinking about in terms of just how do we improve the liquidity. So maybe not so much about the fragmentation piece, but just the general concern that we have. Fragmentation, again, I think it's just here to stay. This was just one of those things that happened as a result of market risks that we've seen elsewhere in the world, and it's also a case of different ways of trading is more suitable to different investor objectives. There are the sort of more higher frequency market making type strategies in place in that space. The people who just want to get the VWAP, on the exchange, but then there are other players who really have large blocks that they need to move. And I mean, I think what's important here is that the regulatory framework and the exchanges and, the buy side and the brokers, everybody, technology suppliers kind of work together to ensure that we have a functioning ecosystem where people can access the liquidity and get the best outcomes for their clients. I mean, that's it. The world is consistently changing and evolving, and we're never going to get away from that. No, I think I'll leave it there.
Thank you, Tris. Yanela.
That's so, on my side, in closing, fragmentation, fully agree, here to stay. It's advisable for those players that, have not invested in technology, that will give them an edge to take advantage of that reality, to start doing so as soon as possible. So that's just candid speak. There is a reality of cycle, which is a macro phenomena, and it's impacting the country as a whole, and it's reflecting itself in the volumes. I mean, 15, 16 billion volumes on average, coming from what, 25 to 30, not too long ago. It's symptomatic of something. If we are to be candid from a, an asset manager that unfortunately has to move big blocks, we will rely on, some of those players that can access different and multiple venues for liquidity. And it puts us in a bit of a, and we're happy about that, but it puts us in a bit of a predicament in the sense that it just keeps us a bit concerned as to where the market is going down the line, worried about concentration and limitation of, the broker selection. And I'll say for me, I think having these discussions is what helps, because now we go back and start thinking about the reality that we're facing and how we're going to be able to manage it. Yeah.
Richard.
We'll see the time's up, and we haven't said the word generative AI. So I just thought I'd say that, and then we can either stop there, or I can ramble on for 4 minutes.
No, thank you, Richard. Generative AI it is. So thank you to my panel. I think that's a wrap. I think it's very clear that across the industry, people are investing significantly in technology, in data, in their people. Very deep conversations are happening. I think we understand the issues. As you say, it's here to stay. I think if in your firms you perhaps not having this investment conversations, perhaps some opportunity to ramp those up. The panelists will hopefully be around. We do have a cocktail event this evening, sponsored by Investec. Thank you. You're welcome, I think, to pick on any of us and to continue the conversation. But until then, if you'll thank me, join me in thanking my panel. A warm round of applause. Thank you so much.